They'll instigate and say, hey, you guys should break up. The share price will go up by 20, 30%.
So on Tuesday, GE announced they were splitting into 3 separate companies: aviation, healthcare, and energy. Toshiba reported a similar plan.
Johnson & Johnson today.
Johnson & Johnson was today. This is in direct conflict with the consolidation and the creation of conglomerates and
but not conglomerates. I think this is an important point, JCal. In the 80s and 90s, it was cool to create conglomerates, meaning you would kind of stick businesses together that were
RJR,
somewhat disparate. Because you could financially engineer a way to do it that would juice shareholder returns, right? You could borrow money, add lots of scale, the cost of debt goes down, you could increase your debt load, et cetera. The challenge is, like, when you're scaling a business, you either need to grow your revenue organically or you need to acquire. And when you're acquiring, you're either acquiring horizontally or you're acquiring vertically, meaning you're kind of integrating your supply chain, or you're integrating, or you're adding ancillary businesses that you can cross-sell. So you're either reducing your costs or increasing your cross-selling ability. So there's some inherent synergy in the acquisition. The problem with conglomerates is there is very little synergy, meaning, like, when you acquire a new business, like an aviation business, it doesn't create synergy for your healthcare business. And, there was always a rationalization that these managers of these big conglomerates had, which was like, oh, well, we could do this and we could do that. At the end of the day, it was financial engineering, where they simply kind of used debt to reduce the cost of capital and increase the shareholder returns. And now everyone's kind of waking up to the fact that you're actually decreasing value, because an investor that wants to own an aviation company doesn't also want to own a healthcare company. So the investor doesn't buy those shares. And the investor that wants to own the healthcare company doesn't want to own the aviation company, so they don't buy those shares. So the way to increase shareholder value is to actually split those businesses up. And then the investors that want to own the aviation business will pay more, and the investors that want to own the healthcare business will pay more. And the overall value of those two businesses goes up by having them be separate. And that's what the market's kind of waking up to. And this is kind of a trend that's been going on for years now, going back to kind of 2013, 14, where the market started to kind of rationalize some of these silly conglomerate business ideas and break them apart into more kind of, targeted businesses that can actually spin out or break off.
Or breakups, yeah.
That can basically attract shareholders to bid on each one of those businesses individually and drive value up. We saw one business I was close to that I saw this with was Dow DuPont, where they, Dow merged with DuPont, and then they split into several businesses that each were focused on a particular vertical. And it made a lot of sense to drive value for the overall shareholders. So at the end of the day, these conglomerates are about kind of driving economic outcomes. And the only folks that you see doing this well are folks like Warren Buffett, where the job is really about capital allocation, where, you can allocate capital to the best business, and that business on its own will grow organically, versus taking a bunch of crappy, low growth, no growth businesses, levering them up to kind of juice the returns on each other. And we're seeing this slow unwinding happening. So I think it'll continue to, and you could probably go and pick a bunch of these conglomerates, and you'll see the activist shareholders doing this. They'll buy a bunch of shares, they'll instigate and say, hey, you guys should break up. The share price will go up by 20, 30%. So if you want a stock tip of the day, go find the next set of conglomerates that are going to get attacked and broken up.
It's interesting, Chamath, and with public markets, Dell is spinning out VMware, and that's going to create a massive amount of cash and shareholder value. They're doing a huge dividend. So I guess my question to you, Chamath, is when do we start to see this hit, not from a point of weakness, but from companies that are strong, and see this as, hey, this is a way to just unlock shareholder value? Will we see an Amazon spin out AWS, a YouTube or an Instagram come out of their parent companies?
I think it's very rare that these things happen on the offensive foot. I think it's typically a defensive maneuver that's driven by really poor returns over long periods of time, or activist investors who want to push for value unlock.
Totally.
Yeah, like,
like eBay, PayPal. Totally. I was about to bring that up. I mean, do you remember how hard that eBay, I remember like John Donahoe was the CEO. He fought that so hard. I remember getting a phone call from him asking if I would support them. He had rounded up Reid Hoffman and other people to support eBay. And I'm like, no, I can't support.
Wait. No, do you remember this? We were in Vegas and Donahoe called and we were working on a plan. And then you went and walked Donahoe through the plan. Do you remember this thing?
No, what happened?
We were in Vegas.
You were going to try to do a hostile spin out of PayPal.
No, I can't. No. Donahoe either called you or called me, and I said, you should talk to Sachs. And we sketched out a plan for what PayPal should do.
I remember that.
And
oh yeah, I do remember that. But
and like on Saturday afternoon, we sketched out this plan.
Yeah. So I told John, no, I'm sorry, I can't support you because I believe it should be spun out. And so the only two people from the original PayPal team who said that publicly were me and Elon. And we said that if you could get PayPal out from under, this sort of eBay bureaucracy, it could be $100 billion plus company.
The bar for acquisitions is extremely high. Like I think the last really two acquisitions that were really done well was Zuck's acquisition of WhatsApp and Instagram. But since then, the bar is extremely high for these conglomerates. So as an example, PayPal was rumored to be buying Pinterest. And, there was such an incredible shareholder revolt that they had to put out a press release saying we have absolutely no interest in acquiring Pinterest. But all that did was just, accelerate the bleeding, because then people were saying, wait a minute, how strategically lost must you be that you would want to buy Pinterest as a result, the PayPal stock price has gotten absolutely
it was over a $300 billion company, and now it lost the entire value of Pinterest basically.
Here's the big issue that I think we have in American economics and company building. We've gone through 20 or 30 years of really underinvesting in R&D at the sake of share buybacks, at the sake of, market consolidation,
dividends,
private equity, driven take privates. And so all of this capital misallocation has really put us on the wrong foot. And the pandemic basically showed that we were really ill positioned. So a lot of these conglomerates, it doesn't make sense today because we've proven that the compensation schemes for CEOs, the incentives for executive management are way too perverted, and they just create horrible outcomes. A different example I saw in the last, I think, 15 or 20 years, IBM's market cap has gone down to 113 billion. In the meantime, they've bought back $132 billion of stock.
What?
Could you imagine the kind of R&D that IBM could have affected with that 132 billion and where they could be? So they're not good capital allocators. Well, we have horrible capital misallocation. So,
look at Apple. I mean,
I don't think they know how to spend the money in R&D.
Yeah, they're not good at it. They're not good at it.
They're better off taking those massive. They're better off taking those massive R&D budgets and putting it into M&A budgets, not for like a $50 billion Pinterest acquisition that doesn't make any sense, has no synergies, but on smaller acquisitions of teams that have built really interesting technology.
I mean, look, IBM could have bought a lot of different things.
They don't seem to know how to innovate or operate. Those guys don't seem to know how to do anything.
Totally.
So my point is, now we're in this cycle where these conglomerates will get ripped apart so that a brighter, fresher, and probably younger group of executive management can take a different spin on these companies and actually do some. So for example, like the J&J spin out is really exciting because you take med devices and pharma and you separate it from a really struggling, complicated consumer goods, package business, the shampoo, the Q-tips, the Listerine, get all that off balance sheet. Now you can actually, make drugs and med devices. And that's a really interesting business that the right CEO can really do a lot of interesting things with.
I heard an interview with the CEO of GE, I think Culp, who was putting forward this plan. The line that I remember that kind of resonated with me, he said, the benefits of focus are immediate. The benefits of synergy are hypothetical. And I think that's really the key point here. And it's what's going to fuel all this sort of deconglomeration is that the benefits of focus to a company are so huge that, but the reason why it doesn't happen is because of this instinct that all of these managers have for empire building, right? So when times are good, they can keep building their empires, and then something bad has to happen to force them to focus.
And
by the way, the motivation, they're not owners. They're typically not founders. And so what you end up seeing is their comp goes up linearly with market cap. So the bigger the business, the more money.
Right. And this is just to close the thought out on that whole eBay PayPal thing. I mean, it was so obvious that eBay should spin out PayPal, but the management resisted it, and it took an activist shareholder. I think Icon came in there.
It was Icon, yeah.
It was Icon who came in there.
When Carl Icahn is in the lobby, you're fucked.
Well, but icons shouldn't have to come in there. The reason why there's opportunity for icons is the managers won't do the right thing.
He unlocked $250 billion of value. He was incredible.
No, I mean, they spun that out for 40 or 50 billion. Now it's worth 5 times that amount.
It's $250 billion.
Yeah, it's crazy. And just to put this all in perspective, the stock buybacks that are going on right now, Apple did almost $20 billion last quarter. They've done $77 billion last year. And you want to talk about the impact of tax policy on innovation. Well, you've got on one hand here, Apple is looking at, well, I'm going to have to pay all these taxes. I might as well just increase the amount I'm buying back and be neutral. Why would I want to show any kind of a profit here? I'll just buy back as many shares as possible. The company will eventually be private. I mean, this is, you got to be really careful with how you do this, because there's no incentive for people now to put money into R&D or other stuff. They'll just buy back the stock might be the most efficient thing to do, correct? In terms of like the share
If you don't know how to spend the money.
It's the dumbest thing to do. It basically shows you're an idiot.
Well, it shows you got nothing better to spend the money on. So maybe buying back the stock's better than frittering it away. But yeah, it means you're out of ideas. It means you're out of ideas.
Or a combination of, my God, this core business is throwing off so much money that we can't come up with enough ideas at that time. I think that's also
it just means you're not ambitious enough.
I mean, what would you spend $20 billion on? I mean, Zuck is having a hard time spending $10 billion on creating the metaverse a year. I mean, you're talking about $80 billion a year. What would you put that towards? What should Apple put it towards?
No, Apple could even more aggressively double down to enter the car market. They could have done it much sooner than they have.
They could spend 20 a year on that. Sure, you're right.
Easily. They could actually enter, I don't know, power. They could,
I mean, but Apple, their culture is to have very few products as a company. They're always very proud of that. It's the Steve Jobs focused thing. I mean, I think it's worked pretty well for them. I know you're second guessing it. The thing that I hear,
I just don't like buybacks because I think it comes at the sake of R&D for most companies. I think
it's obviously, an easy choice.
The big tech companies are different, but everybody else, what you see is R&D is like 1 or 2% of their. It's a shame.
Look, Apple could definitely be more aggressive, but I wouldn't judge the Tim Cook era until we see what happens with glasses, because this is the product that I hear is coming, is going to be their AR glasses, and that's going to be a new computing platform that they open up to developers. And I guess Cook's been there for a decade, but I think he doesn't want to retire until this comes out and he can see this is going to be his signature product, I think. But I'll tell you, just the other thought that just went through my head as I saw this news about GE, it really was kind of the end of an era. You got to remember that back in the 80s, 90s, I think even as late as 2000, GE was the number one company in America by market cap. It was the top of the S&P 500. It later subsequently got kicked out of the Dow Jones. But the thing that went through my head is, when I was a kid growing up, the only two business names that I even knew were Jack Welch and then Lee Iacocca. That was it. That was it. You
had their posters on your wall?
GE and Chrysler.
Farrah Fawcett in between the two of them.
It was big Jack Welch and Iacocca. And now you don't even know the name of the GE guy. I mean, I know it because I watched some interview and I saw him up there. But I mean, you can't think of a business leader today who's not in tech and really a tech founder or somebody who's handed the ball by the tech founder. So we know Tim Cook because Steve Jobs handed him the ball, but otherwise it's all tech founders. You don't hear about any of these old like Dow Jones type companies anymore. It's just the business environment, the economy has changed so much since the 80s and 90s. It's all totally dominated by tech now.
But Sachs, I would argue that the disruptive business and the disruptive business leader are always the icons. Back in the day, the chemical companies were the icons and everyone knew the chemical companies and the guys running them. Then it was the industrial companies, then it was kind of the financial, then it were these guys in the 80s and 90s that did all the
Welch
LBOs.
And Iacocca weren't founders,
But they were in different ways.
Tell me the top two companies on R&D spending. Top two companies without looking on R&D spending.
In the world?
Yeah, global.
In the world.
Number one, number two. Give me number one, number two.
I'd say Microsoft is up there.
No, it depends on classification, but I would say Saudi Aramco.
Freeberg, what do you got?
Yeah, I would probably put Exxon up there.
You guys need to think about who has been some of the most innovative leaders. Amazon, $42 billion in 2020.
No, but Jason, that's an accounting thing. If you're saying in the world, Saudi Aramco, their exploration, their E&P budget is probably $200 billion a year.
Okay, I guess maybe because is that a corporate entity? Technically, it wouldn't be on the list.
Yeah, it's a public company.
Yeah, so
Google's got to be spending $25 billion
Alphabet is
a year.
second with $27 billion.
Oh, off by 2.
Huawei is third, 22. Microsoft is fourth, 19. Apple
so tech
is
companies.
fifth,
You're
18.
saying tech companies.
No, this is all companies. Samsung, Facebook.
But some of this is just accounting categorization.
It's accounting categorization.
Because the engineering budget is basically what goes into R&D. So the more engineers you have on staff, the bigger your R&D budget. Doesn't mean you're producing anything, by the way.
Bigger industrial companies, traditional companies that list things as R&D, most of those dollars flow out to third-party companies like enterprise software companies, services businesses. So it doesn't end up, it gets accounted for as quote unquote R&D because they get to capitalize it. But that spend is typically not paying in-house salaries to engineers. And that's the distinction between true tech companies and other companies that are quote unquote going through a digital transformation or, have a quote unquote R&D budget. They're outsourcing R&D and typically paying 3 times as much and typically getting 1/10 in the return. And I think that's maybe a good heuristic for how you might kind of want to look at what differentiates a true tech company.
Depending on accounting, Saudi Aramco spends $37.5 billion to $50 billion, depending on how.
All right, so that puts them at probably tied with Amazon for all intents and purposes.
That just means I was right, Jason. That's what I care about.
Well, I mean, I'm wondering. Well, you know what? The reason I think that they might not be listed is because they're. Kidding. No, it's a really great insight.
Jay Cal was reading a BuzzFeed article and it was
Barron's. It was Barron's. But anyway, putting it aside, I think the issue might be that they're recently public, right? So maybe they're, they've only been filing public for 2 years or something.